Today, I'm going to look at a couple who is 65 and hoping to retire this year. They have saved $2.5 million and they're wondering, how much can we spend in retirement? This is what our goal is. Are we spending too much and we might run out later? Or oftentimes, even the better question is, are we not spending enough? Because a lot of times people are very afraid to spend too much, especially in those early years, that they'll run out of money. And it's a great point. You can't go back to work when you're 80 and 90 if you run out of money. However, a lot of times we are so afraid of spending too much money that we don't spend enough and we accumulate even more throughout our retirement lives. So unless your goal is to give some to your kids or charities or whoever you select, we want to feel most confident in how much we can spend. So we're going to look at a few options of how much they think they'll spend. And then what if we aren't spending enough? What if we do a few other things? Keep in mind a few things. It doesn't matter how much you have. Typically, a lot of the rules stay the same. So whether you have 10 million, 5 million, 2 million, or $300,000, a lot of the principles will remain constant. I am using 6.15% rate of return on their investments. Yes, I know if we look historically and we predict forward, maybe they will expect to make more. But, maybe a 60-40, 70-30 allocation might be right for them. And let's be a little conservative on the rate of return because we don't know it. You can always change the percent and it makes a big difference. But if this was me looking at my retirement or my family's retirement, I would go a little safer and go with 6.5%. I'm going to dive in. I'll point out a few things and go from there. Here we have John and Stacy Doe. They're both 65 and they're planning to retire this year. Their net worth, they have all pre-tax dollars. So they've done a good job accumulating. They have $2.5 million, about $750,000 in both of their 401ks or 403bs, $500,000 in both of their IRAs. When they retire, they might want to move it to the RMD for consolidation, but this is where they're currently at. They have a home of $525,000. It is fully paid off. However, they don't plan to sell it and downsize, so we won't have what we call a liquidity event, but it is part of their net worth here. Income, since they're retired, we have no working income. However, we'll get Social Security. I put in $28,000 for both of them. You want to look at your own projections and put them there. It's a conversation we have with all of our clients when we're doing a retirement plan. What do you want to assume for Social Security? I can tell you what you're currently getting with the current rules. A lot of people hear it's going to change in the future. I can't promise what they'll do with it. So some people want to go a little conservative. Some people say take it fully out. I don't know if you want to go that extreme, but some people say let's run it with how it currently is. If you're 65 right now, it'd be tough to see them changing it for you. It might be the younger generations. However, we can't make promises there. Social Security does go up with inflation as well. They believe they're spending $100,000. So that's about $8,333 a month. I do always like to recommend and remember clients, okay, those are your normal average spending. We do want to plan for potential roofs, heating and cooling units, extra travel. You're going to need a car or two probably in retirement. So all those big expenses that aren't something you do every single year, we often forget. So we do want to try to average that out of, okay, if I'm going to buy a $25,000 car every 10 years, we do want to try to include that here. Or what we can do is we can just add a new expense and say, hey, in 2035, we're going to spend $20K on a car or whatever. We do assume taxes, so federal taxes. I'm based out of Michigan, so I run Michigan, but if you're in a different state, you just change there. I like to point out the Monte Carlo simulation. What it does is it takes many, many different events and inputs and randomizes those. Oh, okay, what if I have really, really good 20, 30, 40 years of investment or bond returns? Or what if I have very, very bad 20, 30 years and you go through a Great Recession or a Great Depression or the tech bubble? So what it does is it takes a lot of random events, different inflation numbers, and it gives you a percentage. It's very rare to get 100%. Because unless you have fixed income, so Social Security or a pension that covers your living expenses, or you have a lot of money, you're not spending a very big amount of it, it's pretty rare to see 100%. I've seen retirements work quite well with 50%, 60%. There's some things you want to do maybe a little differently, but in this case, I'm looking at 100%, so that's telling me we're in pretty good shape here. The other report I like to look at is the cash flow. Cash flow is the bread and butter, especially in your retirement. So I'll give you a couple things to look at with this page. The first section is your income flows. If you're still working, you'll have your work income here. In this scenario, they'll have Social Security income. Plan distributions will show you any large purchases we input that we're planning to take out on top of our normal living expenses. It also will show your required minimum distributions, RMDs. Essentially what that is you took a tax deduction before. The government now is going to force you to take it out, pay taxes, and get it back into the system. Here in this example, they are close to $140,000, $180,000 in those beginning years, and it could go all the way up to 2-3. So what does that tell us? Right now, we might be in the 12% tax bracket, but with those RMDs, we might go to a much higher bracket. Total expenses show $117,000. So you said, oh, I thought we had $100,000. So with inflation, it goes up slightly, but then also taxes. Since this is all IRA money with Social Security, it's all taxable income when we come out. So we're going to have an extra, give or take, 14, 15 grand of taxes that are owed because we haven't paid tax on it yet. The two columns you most want to concern yourself with is going to be the net cash flow, which is how much money do I have to take out of my investment assets to meet my living standard. So here, since they don't have Social Security come in yet, we have to take out 117 to 124,000. Then when Social Security starts, we take out about 85,000. Now our portfolio of assets, we've done a good job saving. So is it sustainable to keep that going for 25, 30, 35 years of retirement? When we look at it, I would say yes, it looks pretty good. You actually would pass away with more money than you started with in this scenario. So this is where it gets kind of fun. The goal of this client wasn't to die with more than they started. They want to enjoy their hard working years and now travel, relax, spend a little bit more. So maybe we say, hey, what you want to spend this 100,000, what if we want to spend a little bit more? So I inputted a few things. I said, what if you want to spend an extra $20,000 a year on travel? Maybe that's going down south in the winter, renting a place. Maybe that's going overseas. Maybe that's renting a vacation house where you can have your family together. Whatever the reason. If we do that for 10 years, so I put in 10 years because maybe from 65 to 75, typically we don't see, in your 80s and 90s that you're spending 20,000 a year on travel. You spend money on health insurance expenses maybe, but travel, not as much. So what if we spend $20K for the first 10 years? What does that look like? We take out a little bit more from our assets. So our investable assets are a little bit less, but we still pass away with the same or more money than we started with. This is telling us maybe your goal you thought was 100, you were a little nervous to take 120. It looks pretty good here. Maybe we can even do a little bit more. One other one I wanted to point out was we often get clients, they retire, and now they might want to buy a place down south to be a snowbird, or a hunting cabin, or a fishing boat, or a boat for their family, or a cottage to get their family together, or whatever the big expense is. So I put, what if we take out $400,000 the year after retirement to purchase that? And then I also add a little bit, if it's a house, you're going to have more property taxes and expenses. What would that look like? On the column here of the assets, it's definitely a lot closer. This would be a little tight. I think it's very doable. I think there might be some unique strategies you might want to consider, because if we take out 400,000 in that 1 year alone, I'm going to show you the tax report. What that will do is it will significantly increase our tax bracket to, in this case, the highest bracket there is. So our taxable income, that, give or take 100 we're taking out, plus the tax on that. We take out 400 plus taxes on that. Our taxable income is about 815,000. So what's the result of that? They would go from the 12% tax bracket to the 37 federal. Then they would still owe their state. They would also owe more for IRMA, which is your Medicare costs, which is 2 years into the future. They would owe net investment income tax, which is another tax. If you make too much, you pay more. So is it worth it? Yeah, if it's worth it for you, great. Some people say, I do not want to have debt. I just want to pay it off. I don't care. I want to buy this. I want to pay it off, not think about it again. Great. I think that's a great idea. The math side of it might say there's a more efficient way for those people that can look at the numbers. Here, I would say maybe what we want to do is, well, look at the interest rate on that home, but also maybe we stretch that out and we take a little mortgage for 5, 10 years and then slowly take out bigger chunks of money in lower tax brackets and then put it down on the principal to get that down quicker. So instead of going to the top tax brackets, we stay in lower brackets and it makes more efficient. We don't hit the net investment income. We don't hit the IRMA. Now that, again, that's not right for everybody, but I do think it's certainly something that you should talk about and think about. I know I went through a lot of things there that might not have made sense. It is nice to sit across from somebody and explain what each terminology means while we go through this and look at different numbers. Essentially, you want to look at your numbers. A lot of people retire and they actually don't spend enough. And then what they 85, 90, 95, they have more money than they ever thought, but they just can't do what they were hoping to do. So if you know your numbers, you know, hey, what's the ballpark I can spend without spending too little, but I don't want to spend too much. It's very helpful. So you want to be on the same page with your spouse. If you're doing it yourself or your advisor, make sure you're going back and forth and thinking things through and pros and cons each direction. Hope you found this helpful. Now, please closely read these disclosures because they are quite fascinating.